Apologies about this.
No, we forgive you, man. We forgive you. We're obviously talking about gold, and I explained to the people that we're glad to have Matt here because he's the analyst who did the gold sector report for us.
Exactly.
And now we've got you and your wisdom here as well, so that's great because I only know a couple of things about gold. I know it's a good conductor, and I know. I just want to see who's unmuted. Yeah, hang on a second. Okay. Yeah, like I said, I know it's a good conductor, and it's supposedly linked to movements in the US dollar. It used to be a safe haven, but I'm not so sure anymore because last year, I mean, tech is all the rage, but all the tech stocks came down. You got stuff like clean energy, which supposedly nothing can stop it. Yet Tesla, who does clean energy in a big way, they dropped 70% last year. So market's a bit messy. I remember years ago, there was a guy called Dr. Clive Roffey. Some of you may have dealt with him. He was an exceptional technical analyst, and he was a prolific gold bull. Whenever you saw Clive, he'd tell you that the gold price was going to go up. And then if it moves just that much, he used to say, you see, I told you. And I always used to say to him, Clive, you know what? You're right. A broken clock is right twice a day. And he used to get so upset with me, bless him. If he was alive today, I think he would have been very vocal about the gold price at $1,800. But be that as it may, let's see what you clever oaks think of gold, what Matt has made out of the gold sector stocks that he's analyzed. I'm sure our people are keen to hear.
Great, thanks, Sarel. Thanks, everyone. I'm gonna do what I do best and hand over to the person that really knows what's going on. So Matt's gonna talk about it. Obviously, gold, as Sarel said, is very contentious, and there's often it is very volatile. So it does come with a health warning, but there are certainly times when gold is a wonderful place to be. So I'm going to hand over to Matt. Just because of the way we do things is that I'm doing the presentation because he can't. So Matt will tell me which slide to go to, and I'm going to hand over to the guys. This is an excellent piece of work, so I would listen carefully. Over to you, Matt.
Thanks, Vaughan, and thanks, Sarel. So yeah, this report we wrote is nearly 40 pages. So this presentation is just it's a very brief summary of that report. It reviews the SA gold stock. So there's Anglo Gold, Gold Fields and Harmony. And the key points in our report, and hopefully you'll get them from this presentation, is that we try to show that there is some macro support for gold. And that comes from potentially a weaker US dollar, falling US real yields, the demand for safe haven assets. If we go into a recession, normally people flock to gold, and then central bank purchases of gold. But the problem is, we think, so despite there being some macro support for gold, we just think that the gold price currently is a little bit too expensive. And gold, as you'll see, is one of the most important drivers in the valuation. So getting the direction of gold is critical. And we think that because the gold price is asymmetrically high, we're a little bit cautious on these counters. But if we had to choose, we would choose them in this order: Anglo Gold, Gold Fields and Harmony. Thanks, Vaughan. Can we go to the next slide? So these charts basically show the correlation between the gold price and the JSE Gold Miners Index. It's an old index that was discontinued a couple of years ago. But what it's basically saying is that when the gold price is above $1,200 an ounce, there's a very strong relationship between the index and the gold price. So this is why it's quite important at current levels to get the direction of gold right. And we think that, because gold is quite high at the moment, there's it's probably going to come down a little bit first. So there's a couple of charts that I want to show you that will, provide some of the macro support. Thanks, Vaughan. Can you go to the next slide? So this is the first one, and it's the US dollar index. So that's the blue line, and the gold price. I've inverted the dollar index in this chart. So when the blue line goes up, that means the dollar is getting weaker. And normally a weaker dollar is good for gold, because gold is priced in dollars. And if the dollar gets weaker, then it becomes more affordable for foreign currencies to buy gold. And you can see in this chart that the dollar is weakening a bit, and that could provide some support for gold. Then on the next chart, we've got, so this one's quite a compelling chart. It shows that it's got the gold price and the real rates. So as the rates come down, gold price goes up. Gold is when rates come down, gold becomes relatively cheaper to hold, and so demand increases. And this graph, it's quite a strong graph that shows that when the rates come down, gold price goes up, and vice versa. Then finally, on the last chart, this one's got so this is basically the however chart, and it basically shows that given the price of gold and historical rates, the price of gold right now is where that green dot is, and that's a lot higher than the historical relationship suggests. So this is why we think that gold has run a little bit too much. And since our report, gold's come down a little bit, but we think there's still some way to go. Finally, just on the valuation for the three counters. So the way that we have tried to value them is by forecasting the EBITDA based on a number of variables. The big ones are the gold price, and then management guidance on costs and production. We assume that the current EBITDA multiples will hold, and then we get to our bull and bear case scenarios by adjusting for the price of gold, and that gives you basically, like, wherever you think the direction of gold is going, you can make a call from this chart, and it gives us a range of outcomes, and we use that range to inform our calls. So you can see here on Anglo Golds, that's got the most upside. It's got quite a wide valuation range, but the most upside out of the three of them, and the downside is pretty similar to Goldfields. And then in addition to that, we like Anglo Golds for other things that are difficult to incorporate into the valuation. So Anglo Golds is the most diversified out of all of them. It's got good assets, strong balance sheets. Goldfields has got some issue with management, and Harmony is just too exposed to South Africa, where labor and electricity costs are quite high and also quite volatile. Well, so that's pretty much the summary.
Okay, so Matt, what you're saying is the difficulty lies in getting the gold price right, and those graphs that you showed show the relationship between the gold price and the interest rates, which we know are currently quite high. So that may or may not support the gold price going forward, should interest rates stabilize or start coming down. Am I right?
Yeah, so it's quite it's quite difficult to call, because the first couple of charts in this presentation show that there's a lot of macro support for gold. There's a lot of signs that say that the gold price should be supported or could go up, except when you look at that final chart on the relationship between rates and gold.
Okay, so the final chart says it's expensive, but the rest suggests that it can either be well supported or may even rise.
Correct.
If that is the case, then we definitely would rather be in Anglo Gold than GFI and Harmony.
Correct.
As Vaughan suggested at the start of the presentation, I mean, it is a wild ride. If you look at it, in November, Goldfields was around 150, 160, shot up to 200, and they're now at 193. Now, if you'll just go to the next slide, Vaughan, I think those intrinsic values of yours. Goldfields intrinsic value 186, so that's above our intrinsic value. Harmony was 52 in November, shot up and currently trading at 63, so that's miles above our intrinsic value. And Anglo Gold is our intrinsic 386. The stock's currently trading at 360, but it was 260 at the end of November, or in November. So it's already run quite a bit, but that's the only stock that's also below your intrinsic value. So if you own gold, then you should definitely switch to Anglo Gold Ashanti. I think from a technician's point of view, and I'm looking at the chart here on the right-hand side, I think I'd feel more comfortable to pick it up around 340 than around where it is at the moment, at 360, 320 with a squeeze. And as Matt's, I'm looking at that downside risk of ease of around 20%. 20% on 360 is about $70, so it could come down to 300 in a worst-case scenario, I guess. So, yeah, I'm just trying to do the math for myself here. Are there any questions out there from the audience, guys? See the chat.
Sarel, I've got quite a few. Can I shoot?
Yeah, fire away. Fire away,
Okay.
James.
Yeah, so the first one I have is, to me, if you invest in this, we all hope for upside in the gold price, which will obviously drive these share prices up. If the gold price goes up, I'm not saying it's going to go up, but let's say it does go up. There's a lot of uncertainty in the world. So my question was when you buy these miners, in my opinion, and the reason I buy them for their reserves, because all of a sudden you buy the future gold they're still going to mine. Now, in this evaluation, was the reserves taken into account? Because I haven't done a study on it, but I'm of the opinion that of those three, Harmony probably have the best reserves that could be quickly brought that could be quickly mined. If, let's say, because you must remember, if the gold price goes up, all of a sudden reserves that was uneconomical to mine in the past becomes economical to mine in the future. So was that taken into account? Because to me, the reserves is a very important aspect of evaluating these companies. And I think of the three, I agree Harmony is probably the most riskiest, the most volatile, but for a good trader, probably the one where you can make the most money on. I have quite a big stake in Harmony. Thanks.
Okay, so James, let me start off and then I'm going to hand over to Matt. You clearly know about gold. So the issue is, as you know, with the prices going up, your resources become into reserves. Your reserves go up, and obviously then the present value of the mine goes up. The problem is that you also have a situation in South Africa where we know the cost growth have been growing at a compound 12% for the last 15 years. So the stability of the country is a little bit weaker, etc., etc. So a lot of these miners are also voting with their feet. And they're voting with their feet by buying ounces and or mines outside of the country. So whereas you're completely right that potentially that would go up, it is what I would call a black art to do the reserves versus the gold price, because I've been watching gold companies, not in great detail, but watching gold companies for 25 years, and every single time they come out, it changes. So how do you do it? Remember, we've got a hat on which is a bit more portfolio based and risk based. So we would far rather give up 50% upside to take, or we'd rather give up 50% upside and not take a 50% downside. So we will, on a risk-adjusted basis, always go for a 30% upside, but 10% downside. So Harmony is one of those ones that is highly volatile. As you rightly point out, if you're a trader and you are good at trading, you can make a lot of money. If you're an investor, we don't really like those odds. Matt, if you want to add to it.
Yeah, I'll just comment on the reserves. We don't necessarily, we do look at it, but we don't necessarily incorporate that into the valuation. More of what we do is we look at what management say they're going to produce versus what they can produce. The other stuff we take into account, it kind of forms the bias around the intrinsic values. So on Harmony, they've got, their expenses are quite a lot higher than the other two because their mines are more underground than the others. And then Anglo Gold's got some great assets up in Ghana, which have got really long lifespans and grades that should improve as they go deeper. So that's how we look at the reserves.
Thank you.
Yeah, see, Andre says, please comment on the demand that surged to its highest in more than a decade in 2022. Was that mostly because of central banks buying? You guys got a view on the demand surge?
Yeah, so
was it war related or?
Go ahead. No, go ahead, Matt.
So there has been a lot of central banks buying. There is a chart in the report which shows that over the last decade, the amount of gold being purchased by central banks has increased quite a lot. Where we are now is it looks like that graph actually isn't in this presentation. But
no, I know. I'm just highlighting this.
But it is in the report, and the central bank purchases in the last year look like they've flattened out a bit. But commentary from the World Gold Council, and that's where I got that data from, is that very recently there's been an uptick in central bank purchases. The only issue is that data takes a while. It's quite delayed because a lot of the central banks take a while to report their reserves. I don't know if that helps with the question.
Sorry, if I can just add in as well, is that obviously you can see what I'm highlighting here is the macro support for gold. So we are taking that into account, and we are certainly positive about the long-term demand scenario for gold at the margin, given the fact that the dollar as the reserve currency of the world is probably somewhat challenged. But it's not going to change overnight, and it's probably a 20-year plan. So the key point we're making is we don't want to overpay for something that we fully believe in.
Thank you. Any other questions from the people? I don't see any in the chat. Switch on your mic and ask, guys. If there are no further questions, last round. No, it doesn't look like it. Looks like you guys explained it well. I want to know from the audience, and I want to invite you to send me a mail to my mailbox. I'll type it in the chat for you. If you want to get sight of that full report, I will gladly send it on to you. sarel.snyman@psg.co.za. As I've said, it's a 38-page report. It's quite an extensive report. Some good reading. If that's going to help you make up your mind whether you should have gold or not. As just for interest's sake, I created a poll to see who in the audience actually does hold gold shares or gold exposure in their portfolios. So I'm going to launch this, and then if you'll just quickly answer for me on the screen. Let's see, there we go. There's the poll. Just click on your selection and say submit. Okay. We've got 19 responses so far, with 74% saying they do not own it. There, it's moved almost to 50-50. 25 responses, 26. Yeah, I think it's safe to say that 1/3 does hold gold and the other 2/3 not. James is commenting here in the chat. He says gold is very much out of fashion. Yeah, James, it does look like that if you look at my poll. Any last questions? Last of the last, guys? We've got the clever oaks here. I think all the questions have been answered. I just want to remind you, thank you, Vaughan and Matt. It's been interesting. And as I've said, please email me and I'll send you the full report, guys. Something completely off the topic of gold, I wanted to remind you that the end of the tax year is here. Yeah, Nolan says he's got GLDs. And I was wondering, whilst you guys were talking, Vaughan, benefit of having GLD over, say, Harmony, because, I mean, GLD is just a pure gold play. It's just a price play versus the actual producer play. Have you got any opinion?
Yeah, so often you do want to hold the gold, and I was going to make the point that gold is a good hedge, given the fact when the market's very volatile or when it's crashing, gold is typically negatively correlated, so it's pretty good. As a general rule, though, you've got to remember our mandate is a equity portfolio, so we try to minimize the non-equity holdings that we have. For those investors who have a multi-asset type mandate, then you could hold the gold relative to the equity. So we do look at the two, but if you're going to hold equity, you are taking risk and you want to be paid for that risk. So often we will rather buy the stocks, and in order to mitigate the risk, we would buy a lower risk gold. Pretty much the argument that Matt's laid forward. We like Anglo Gold over Harmony.
Okay, and if you have to have physical gold, you may as well buy Kruger's as well. I had a mate and he still got that strategy today. He bought Kruger's and put them in his ceiling. He says it's the last place people that break into your house will look for valuables. So he kept his Kruger's in the ceiling of his house. That's his gold play. What I wanted to say was it's the end of the tax year, guys. We know tax experts, but speak to your tax consultants. If you made capital gains larger than 40K, your annual exemption, then you could actually sell those stocks that you're making capital losses on. And I mean, there's quite a couple around in the volatile situation that we had last year. So to harvest some of to offset some of your gains against one or two losses that you're carrying, I wanted to remind you of that. And then I wanted to remind you that you need to top up your retirement annuity to save on tax and for retirement. Remember that most of the product houses, ourselves included, need that money probably by the 24th of Feb, because it has to reflect on our side for it to be taken into account for the current tax year. Your contributions, remember, you can pay 36,000 on your tax-free and up to 350,000 or 27.5% of your taxable income on your RA. So don't forget those cutoff dates. It's getting close. Top up your RAs and your tax-frees. We'll get another topic together and we'll let you know soon what it's going to be, and then we'll see you again next week. Thank you very much for your participation. And Vaughan and Matt, thank you very much for helping us. We're learning a lot.
Thanks, Matt. Nice one.
Cheers, guys.
Thanks,
you.
guys.
Bye-bye.
Cheers.